Hi guys and welcome back. This is a very interesting topic. It's different from what I normally do and it will be improvised. So apologize if I might stutter a little bit because there's a lot of information. There's a lot of interpretation. I'm gonna use some data we have, but I'm also gonna use some stuff that I'm gonna deduct from other data points. So let's get started. In the past couple of days, my TikTok has been blowing with information about Silicon Valley Bank, the bank of all the venture capitalists down in Silicon Valley, and how in a matter of a couple of days we went from the bank has no money to the bank is trying to raise money by selling off assets at a loss to a total bank run, and now to a failure of the bank, which now has been managed by the FDIC, which is the insuring entity by the government for banks. What has happened? Basically, a few days ago, SVB Bank, Silicon Valley Bank, a bank that normally does commercial banking for companies down in Silicon Valley, we're talking about startups and everything, had a problem with liquidity. They sold off many assets at a loss, assets that they bought, kind of like treasuries that they bought back in the day where interest rates were much lower, and it caused them to go on a loss, it caused the stock price to go down. Some people got scared. When a few of these tech entrepreneurs started pulling money out, people went for a bank run, and fast forward to Friday, so yesterday, and the bank is now in insolvency. This is pretty much what happened. Now, if you look at headlines, of course, terror is everywhere. One of the biggest banks in America is crashing. One of the biggest banks might have a ripple effect across all companies in the US. Is this the first one? This is the first major crash we've seen in a while, the biggest one since 2008. Well, everything is correct. Of course, people are not pointing out all of the issues and all of the data. They would simply want to create terror, and I'm here to bring you some more data and give you a different point of view, maybe to help you chill out a little bit. We're gonna start with who is Silicon Valley Bank. Let's go on their website and we're gonna hit record right here. Let's go on their website. Who is Silicon Valley Bank? Silicon Valley Bank is a commercial bank. This bank works with companies, works with entrepreneurs. It is not a normal bank like Bank of America, TD Bank. They do not focus on day-to-day customers like me and you. These guys work with a lot of money. They work with venture capitalists. They get a lot of money, commercial loans, different kind of investment. Riskier bank. It is still a bank, but it has a different focus. So as you can hear, if you go on their website, although you cannot do it now probably, if you see the products, startup banking, venture funded, corporate banking. You don't have a personal savings account, you don't have a personal checking account. So you know already this bank here is focused on companies, which means probably riskier. With that said, yes, we saw a couple of articles, reactions to the Silicon Valley Bank meltdown, what happened. Here we have an article about people who pulled money out before the bank went in insolvency. Very interesting thing, how one large, let's say, withdrawal caused multiple people to pull out money, and how many people are pushing money into other banks similar to SVB. Now, to confirm what I just said about venture banking, again, to confirm that the bank does risky commercial stuff compared to less risky personal day-to-day people stuff, here's another. You simply Google which banks work with most startups. SVB, FRB, Roe, and Mercury. If you look at other articles, you see how many entrepreneurs push the money into others of these banks here. So, will this cause bank runs on other banks? We don't know, but interesting to see that a lot of the money was put into other venture capitalist banks. Now, in terms of the headlines you see around, how big is this bank? It's pretty big. I mean, it's number 16 in America, or 17 in this case. People say 16, but here we can see 17. If we go on this other one here, it's 19. Why? Because it has $212 billion in assets. Assets can be loans, can be treasuries, can be investments, and it holds $176 billion in deposits. Now, the crazy thing of this is if you have a bank account, a personal bank account, you are insured by the FDIC, which is a separate government entity, to up to $250,000. What was interesting in this bank here, which confirms what we just said, that it is a commercial bank, it works with venture capitalist firms, it works with companies, is that most of these deposits were large. And if we go here, more than 85% of Silicon Valley Bank's deposit were not insured, which means that more than 85% of the deposit had more than 250K. Why? Because we're talking about companies. So this is where stuff gets tricky, which again confirms that this is a commercial bank. These customers here will not affect day-to-day users unless it's the employees of the companies that need to be paid through these bank accounts. That is an issue, but will have ripple effects across all of America. Well, if the rest of the banking system is good, I don't think so. This simply affects the venture firms that work with SVB. I'm always confused with SBF from FTX and these guys, but never mind. So 85% of these bank accounts have more than $250,000. So we know that 15% of those bank accounts will be reimbursed fully, but the rest, we don't know what will happen. What are the ripple effects of such a system? Well, all the companies that are banking with them will lose probably some money. All the vendors that work with those companies might not be paid. So if they have a large contract or they already provided some service, it might not be paid, it might not be paid on time. So that is the ripple effect. It seems to me that also if you look at branches, most of the usage is in Silicon Valley. So the ripple effect might be mostly in Silicon Valley. Will have ripple effects across other banking systems. We don't know about that. I know that SVB worked in the past with Asian banks, so that might have effects on the Asian partners, but will have effects on larger, let's say, banks like Bank of America, Chase and stuff. We don't know about that. Let's go on to some other technicalities. Why do I not think that this case here will have ripple effects across other banking systems? Let's talk about the average American. If everybody would try to pull their money, how many people actually do have money to pull in America? And you see stuff like this. 50% of Americans do not have $1,000 emergency funds on their bank accounts, which means that if we have a population, US population, of 330 million, it means that 170 million people cannot even pull $1,000. So we already have those out. Most of these people are banking with the bigger banks. If the majority of people cannot pull even money out, the risk of a bank run is much less because there's a little money. They mostly use credit cards. On top of that, a lot of people do not even have $100,000. And if you look at assets and liabilities of these bigger corporations, bigger banks here, they're still pretty solvent. They have a good liquidity. JP Morgan, Bank of America. Of course, the numbers can be tweaked on the back end, but it seems to me that they're pretty solvent. The problem of SVB Bank was that it was working with more risky assets. It bought a lot of wrong assets, and compared to its size, that investments it did really hurt the company. They had treasuries that were bought in the past couple of years where interest rates were low. Now that interest rates went up, the value of those treasuries plummeted. And to recover the loss, they tried to raise money like by, for example, selling their stocks, which dropped the stock price, created insecurity, and brought them to the situation they are in today. I do not believe that this issue here will have ripple effects. It is a different kind of bank. It is not average peasant bank for me and you. So it might not affect us to the same extent it will affect these Silicon Valley companies. It definitely will have some bad effects on these companies here, but not on us, especially if you are in other areas. Let's go to something else very interesting here. Bank failures. Another of the headlines you see around is that this is the largest bank failure since 2008. Are bank failures normal? Well, the pandemic kind of blocked everything. However, we always had bank failures in the past couple of years. Look at this. This is a list of bank failures since 2009. Of course, 2009 was a lot. But if we go back to 2011, Look at this. This was still the effects of the financial crisis, 2012, 2014, 2015, 2016, 2017. These are smaller banks, but we always had bank failures. It always happens. I've looked into some of them. It is mostly, again, due to bad investments that the bank did and losses. Because the one thing that happened after 2008 were many, let's say, solvency laws to protect banks from failures, from bank runs. The limits were increased to protect the banks. And we had the failures all the way to 2020. After 2020, I believe that there were some kind of moratorium, memoratium. This is now all speculation. I didn't look into it. I might look into it, but I believe that there were some measures put in to protect. The newest one, of course, is SVB that we see here. So bank runs, bank failures are a normal thing. This bank failure was pretty big. Number 16 in America is a pretty big bank. It is not gigantic as something like Bank of America, but it is pretty big. And it is mostly commercially related. So I don't think it will affect everyday users unless you work for a company that is banking for them and you were, let's say, leaning on that bank account to get your salary. You might have some temporary issues. If companies were able to pull money out or will be able to pull money out to keep for their employees, it should be fine. We're gonna see that. The fact is, it is a different kind of bank. Bank runs are normal. It is commercially focused, not for everyday users like me and you. Will it affect other banks? Well, it definitely, the media out there definitely will create some uncertainty. But even if we would have a lot of people trying to pull their money, we know that the large majority of Americans do not have money to pull out because they're in debt and they cannot afford a $1,000 cash expense, which kind of removes partially the risk of bank run. It's not a good thing to have, of course, because 57% of Americans cannot afford a $1,000 expense. But on the other hand, it protects banks from a bank run, knowing that people don't have money to pull out. Guys, this is all for now. Very basic video. I just wanted to give you the full picture of what is happening, what bank it is, what the bank does, how big it is, and some history about bank failures. I hope this tranquilizes you a little bit, makes you chill out for a second, because there's a lot of negativity out there. Of course, this is nothing positive. It is very bad, especially for startups, but not financial advice. I believe that this does not have ripple effects across the entire banking sector of America. Thank you for watching. Ciao.